314 Research co-founder, and Steve Sosnick, Interactive Brokers chief strategist, along with CNBC's Leslie Picker, with some fresh comments from one of Wall Street's most important voices. But gentlemen, I will start this conversation with you because, as I just mentioned, and Warren, I'll start with you. We did have a NASDAQ composite and a NASDAQ 100 that finished fractionally higher, and an S&P that finished fractionally lower. It looks like 50.62 maybe is where we're settling out on the S&P. Warren, we came into this session arguably very oversold here. We saw a massive flush out, a lot of margin calls coming into today. Is this a dead cat bounce, or is this a market testing its bottom?
Yeah, thank you for having me. Look, I think there are two important price levels to define for viewers. So if you study history and you go back and you look at where should we expect this market to bottom without a recession, then I think we're at a place that's a pretty compelling entry point already, which is like anything below 5,100, you're looking pretty good. However, if we have a recession, then, we're 500 points lower. My view is we're not going to have a recession, that the policies that have been proposed are not sustainable. It's kind of more, should be looked at more as an opening negotiation. And therefore, I do think we're going to avoid recession. So I think when we look out 1 year, this is going to be a pretty good buying opportunity for investors. And we've been pretty cautious coming into April. So, yeah, I think it's there's no telling if it's the actual bottom. Sometimes you have to decide if you're going to be early or late in these situations. Personally, I'd like to see technical confirmation, but sentiment is really washed out. We see sentiment on our institutional measures, retail measures, and the VIX at 45, 25% forward returns from that point historically. So I think we're getting close to a real bottom.
Steve, we've had these conversations, you and I have on this show. We've had these conversations with other folks coming into this year as well, that this was going to be a volatile year. I mean, look no further than today, and Warren just touched on it, but you have a VIX that's at very, very elevated levels as one sort of marker of the activity we've been seeing in this market. Your thoughts here, especially as we've talked about in recent months, the role that individual investors have been playing in stock moves in general.
Yeah, I'm Morgan. There's a lot to go on here. I mean, the volumes have been incredible. We set records on Friday in both stock volume and option volume. So that's a tremendous lift. And from what we could see among our customer activity, the volumes were steadily increasing throughout as the week went on. Interestingly, among our 25 most active names, as of last week, 24 of them were to the buy side. The only exception was Alibaba, and that was very slightly net sell activity. So our customers remain buyers. There's definitely still a big, faith component in the market. Clearly, there were participants who had some issues, whether there were leveraged investors, people got a bit overexposed. I do think some of the selling came from risk parity funds, which then sort of require you to sell stock as volatility goes up, which is kind of counterintuitive there in some ways. But basically, I'd say many investors are holding firm, and you could see from today's activity when we went, from down 5% to up 3.5% in about a microsecond. It's telling you that there is still residual demand for stocks, and nobody wants to miss a rally.
Warren, I want to get your thoughts on what you've seen in some of the other asset classes as well, because crude oil, something I know you track, hit its lowest levels since April of 2021. It looks like we actually finished with crude back above 60 in the close a couple hours ago. But you also saw bond yields, which had come off dramatically in recent sessions, tick higher today, too. What are these markets telling us?
Yeah, I think the first with oil, there's been a supply problem for a while. It's something we've highlighted for our clients. And I think that so there's a whole nother drama going on there with OPEC returning more oil to the market than investors had expected. And ultimately, there's a lot of confusion around tariffs. Is it inflationary? Is it growth negative? The answer to all those questions is ultimately yes, but it's mostly a growth scare. It's a growth negative. And so obviously crude oil, one of the most economically sensitive assets on the menu, has gotten hit. Bonds are a little trickier. I think they've been acting more or less like you would expect until today. And then we saw a lot of selling. The rumors going around are that these were potentially foreign sellers of treasuries. I don't think we have evidence for that story yet, but I mean, that just shows that that is a potential consequence of this entire quote unquote trade war that Trump has initiated, is that we have, we buy stuff and foreign countries buy our our debt and equities. And so if we unravel that relationship, then obviously the potential is for those capital markets to suffer. So those are really the oil is a growth story, and in bonds, I think they're a little bit caught between two forces here, but I wouldn't make too much out of today's action.